Imagine for a second that you sit down to look at your personal savings.
Okay.
You've got a certain amount in there, maybe, something you've been steadily building up over the last decade. Now try to imagine growing that exact amount by 5.5 times.
Oh, wow. Yeah, that's a massive jump.
Right, and we're not talking about doing this over a lifetime of, patient investing. We are talking about pulling this off in just the next 12 years.
Which is pretty much unheard of.
Exactly. From a personal finance perspective, that sounds almost impossible without winning the lottery. Now, scale that thought experiment up. Imagine an entire country trying to pull off that exact same mathematical feat with its entire economy.
It is a genuinely staggering level of ambition. I mean, you're talking about attempting to engineer an economic leap that would essentially redraw the entire global geopolitical board.
Welcome to the deep dive. Our mission today is to unpack a really detailed, incredibly ambitious document. We are looking at a reform agenda put together by Icarus Research, and it's titled India's Road to a $20 Trillion Economy.
Yeah, and what is compelling about this source material is that it isn't just, a vague wish list of economic hopes.
Right, it's not just theory.
No, it's a granular 20-step playbook. It actually attempts to map out exactly how India could take its economy from roughly $3.6 trillion in 2024 to a massive $20 trillion by the year 2036.
And addressing you, the listener, sit back, because this is basically a shortcut to being incredibly well-informed on global economic strategy.
And to give you some context on why that specific timeline matters, this report argues that the structural mechanics of how the economy grows over this specific 12-year window are just as crucial as the speed of the growth.
Yeah.
It's essentially a fundamental rewiring of the machine while it's flying.
Okay, let's unpack this because we really need to start with the sheer scale of the math required here. The report points out that it took India 67 years from independence in 1947 all the way to 2014 just to reach a $2 trillion gross domestic product.
Which is a long time.
Yeah. Then the pace shifted. It took only one single decade to nearly double that, hitting roughly $4 trillion by 2024. But jumping from there to $20 trillion by 2036, the report states that requires a sustained nominal growth rate of about 18% in dollar terms every single year. And I mean, I have to push back on this right out of the gate.
Go for it.
An 18% annual growth rate sounds completely disconnected from reality. Historically, India's growth trend hovers around, 10 or 11%? How does a massive economy suddenly jump to 18% and just hold it there for a decade?
Your skepticism is entirely warranted. I mean, it is an astronomically high bar. But what's fascinating here is that there is an actual historical precedent for a leap of this magnitude.
Wait, really? Who?
China. They sustained an 18% nominal growth rate for 11 straight years, starting from a very similar economic base of around $1.7 trillion.
Oh, wow.
So it has been done. However, to pull it off, the report details that India needs two very specific mechanisms to work in absolute tandem. First, a massive lift in the underlying domestic growth rate. And second, a gradual but sustained appreciation of the Indian rupee against the US dollar.
Ah, okay. So the currency itself has to do some of the heavy lifting. Like if the domestic economy grows at, say, 14% and the value of the rupee gets 4% stronger against the dollar, those two combine to give you that 18% growth in dollar terms on the global stage.
That is the exact mathematical formula, yeah.
Right.
You need the currency to cooperate to translate that domestic hustle into global dollar valuation. And achieving that underlying 14% domestic growth requires an entirely new economic engine.
Right, because looking at the sectoral breakdown in the report, it made me think of the economy like a three-stage rocket trying to break orbit.
Oh, I like that. How so?
Well, the first stage is agriculture, which currently sits at about 17% of GDP. But as a country modernizes and urbanizes, agriculture naturally shrinks as a total share of the economy. So that first stage is basically burning out.
Right.
The second stage is manufacturing, currently making up 17 to 20%. But the report notes a major headwind here, which is that global protectionism is rising. Countries are throwing up tariffs, subsidizing their own factories.
Exactly. So that second manufacturing stage is effectively capped. It can't provide maximum thrust anymore.
Right. That leaves the third stage services to carry the entire payload. To hit the target, services have to jump from 54% of the economy today to over 65%.
Which means transforming the services sector from roughly a $2 trillion industry to a behemoth generating over $11 trillion. That structural shift, away from the traditional manufacturing route, is the entire philosophical foundation of this 20-step agenda.
Oh.
But before a rocket can accelerate, you have to patch the fuel leaks. You simply cannot boost that high-end services engine if the real economy on the ground is mired in basic inefficiencies.
Which provides a really clear transition to the first set of reforms in the report, plugging the leaks in the real economy. And there was a statistic in here regarding food logistics that was just incredibly frustrating to read.
Yeah, the food loss numbers.
Right. India loses about 50 million tons of horticulture fruits and vegetables every single year. That translates to 1.5 trillion rupees worth of food literally rotting away.
It's a massive drain.
And the reason why is that only 4% of fruit and vegetables travel in a cold chain. Just 4%. For context, the report compares that to 82% in the United States.
It's a stark contrast.
If you apply that to everyday life, imagine buying groceries for the week, walking out to the supermarket parking lot, and throwing a fifth of your bags straight into the trash before you even leave.
Yeah, it acts as a massive, invisible tax on the entire agricultural sector. The report's proposed fix is highly targeted, though. They suggest offering a 10-year tax holiday specifically for micro, small, and medium enterprises, the MSMEs, to build out cold storage infrastructure.
So by removing the tax burden for a whole decade, you drastically shorten the time it takes for a small business owner to pay off the massive upfront costs of buying, like, refrigerated trucks or building cooling warehouses.
That is the exact incentive structure. The logic relies on the idea that even if you only have the current spoilage rate, you put billions of dollars of lost value back into the system. You add an estimated $4.5 billion directly to the GDP without having to grow a single extra crop.
That's brilliant. And speaking of moving things around, the report dives deep into general logistics, which seems to be punishing the smallest players the most. It highlights that logistics costs eat up about 17% of output for the tiniest firms, but only 8% for the largest corporations.
Yeah, and a massive culprit behind this disparity is that fuel currently sits outside the GST, the goods and services tax system.
How does that hurt the smaller players?
Well, this is a critical point of friction for the entire economy.
Yeah.
To understand why, you have to look at the mechanics of a value-added tax like the GST. Normally, a business gets an input tax credit.
Okay.
So if you make shoes, you pay tax on the leather you buy. When you sell the shoes, you collect tax from the customer, but you get to subtract the tax you already paid on the leather.
Yeah.
It basically prevents taxes from piling on top of taxes.
Right, but because fuel isn't under the GST umbrella, a trucking company can't claim an input credit on the diesel they buy.
Exactly the problem. It becomes a dead compounding cost. Right now, if a liter of fuel costs 97 rupees, the base cost is actually only about 66 rupees.
Wow, really?
Yeah, the rest is central excise tax stacked with state VAT. The report argues that if you fold fuel into a standard 18% GST bracket, that liter drops from 97 rupees to about 78 rupees.
That's a huge drop.
It is. Across the entire transportation network, that single mechanical change frees up an estimated 5.5 trillion rupees, drastically lowering the operating costs for those smaller businesses.
Wait, let's look at the other side of that ledger for a second. If they drop the price of fuel that drastically by bringing it under GST, the central government is going to lose a massive amount of excise tax revenue, right?
Oh, absolutely.
Are they just like accepting a huge budget deficit to make this happen? Because the report mentions the central government would lose about 1.6 trillion rupees.
They are taking a severe revenue hit on paper. However, the report justifies this through economic multipliers, specifically by demanding the government fix another glaring inefficiency, which is unspent state budgets.
Unspent budgets.
Yeah, in a recent fiscal year, Indian states budgeted 10.26 trillion rupees for capital expenditure. That's the money earmarked for building tangible assets like roads, bridges, infrastructure. But they left 2.3 trillion of that completely unspent.
Wait, they went through all the trouble of budgeting it and just left it sitting in the treasury.
They did. So the reform proposes instituting mandatory state capex floors. If you force the states to actually spend the money they have already allocated, you trigger a powerful multiplier effect.
Right, because when a state builds a highway, they pay the construction worker.
Exactly. Who then buys groceries, which pays the grocer, who then expands their shop. The velocity of that 2.3 trillion rupees entering the real economy generates enough overarching growth in tax revenue to easily offset the central government's 1.6 trillion rupee loss from the fuel GST.
So you generate massive economic stimulus without a single rupee of new borrowing. You just force the system to operate as designed.
Okay, so we've patched the physical leaks. The supply chains and infrastructure are moving more efficiently. But To fund the leap to a $20 trillion economy, you need capital.
Yeah.
And you can't just aggressively tax the public to get it.
No, definitely not.
Which brings us to the capital markets section of the report, specifically focusing on unlocking trapped capital.
Yeah, this is where the structural engineering of the economy becomes really sophisticated. The government possesses enormous assets, but those assets are incredibly illiquid.
Let's start with the Indian railways, because the numbers here are massive. The railways consume about 2.8 trillion rupees annually in their capital budget. That is almost 5% of the entire union budget, purely funded by taxpayers.
It's a huge expense. And the report's proposed solution, take it public, lists the railways on the stock market at a valuation of roughly 3 times its revenue, which they estimate could be worth $500 billion. Suddenly, the private market is funding the railway's growth and modernization, and that 2.8 trillion taxpayer rupees is freed up every single year to be deployed elsewhere.
It creates a permanent expansion of fiscal space. But the report pushes this logic even further regarding government assets, turning to what is essentially a masterclass in capital allocation.
Okay, let's hear it.
The Indian government currently sits on about $249 billion of equity spread across various public sector companies.
Here's where it gets really interesting, because looking at those numbers, the government is essentially operating like a homeowner who is house rich but cash poor.
Yes.
They're sitting on $250 billion in equity, but they are constantly struggling to find liquid cash for the annual budget.
You've hit on the exact paradox. The proposed solution is to pool all of that scattered equity into a single, professionally managed sovereign holding company. Rather than listing or selling the individual companies, you list the holding vehicle itself.
Why does adding that layer of a holding company make a difference, though?
Because it separates ownership from management. When politicians are directly managing public sector companies, decisions are often driven by, well, political expediency rather than efficiency. By placing these assets under a professional holding company, acting essentially as a ruthless property manager, you drastically improve corporate governance.
Which in turn boosts the valuation of the underlying assets.
Exactly. The report estimates that if the government sells just 5% of that growing holding fund each year, they raise between $13 billion and $32 billion annually. And because they only fell 5%, they never lose ultimate control of the strategic assets.
The report points to Temasek in Singapore as the benchmark for this. And reading up on Temasek, they started with a seed fund of just 354 million Singapore dollars back in 1974. Over 50 years, by operating as an independent, commercially driven holding company, they compounded that into over 520 billion.
Incredible growth.
Yeah, and India is sitting on a starting seed that is exponentially larger than what Singapore began with.
It is a proven model for state wealth creation. But the report notes that it isn't just government capital that's trapped. Vast sums of private capital are also locked up by archaic tax frictions. The report heavily targets something called advance tax.
Oh, this one felt particularly burdensome. Basically, businesses have to estimate their future income for the year and prepay the taxes on it in 4 quarterly installments.
Right.
And if a business has a surprisingly bad quarter and guessed their income wrong, they actually get penalized with interest by the government. It functions like an involuntary zero-interest loan from the private sector to the state.
Yeah, it is an unnecessary escrow account that freezes the gears of small businesses. The US and the UK generally don't run quarterly installment systems for ordinary corporate taxpayers in this manner. The report points out a crucial fact, though. Abolishing advance tax doesn't actually cost the government any total revenue.
Because the tax is still paid in full when the business files its final return at the end of the year.
Precisely. But by simply changing the timing of the collection, you release an estimated 10 trillion rupees of working capital back into the private sector to actually hire people and buy inventory.
And the reform proposes doing the exact same thing with investment income.
Yeah.
Currently, the government withholds 10 to 20% tax at the source known as TDS before the tax is even officially owed by the investor.
Yep.
The investor then has to file and wait, sometimes over a year, for a refund. The proposal is to drop TDS to a flat 5%, which instantly frees another 13.4 trillion rupees.
It's massive.
Combine those two, and the government is effectively holding over 23 trillion rupees of the private sector's working capital in administrative limbo.
Releasing those funds acts as an immediate, massive economic stimulus, and you do it without the central bank having to print a single new banknote. However, there is one more significant distortion in the capital markets we must cover to understand the full picture. and that's small savings schemes.
Right. There is a 24 trillion rupee pool of capital sitting in these government-administered small savings schemes. The issue the report flags is that the government guarantees high returns on these accounts, sometimes 7 or 8%, even when broader market interest rates fall.
Which creates an artificial floor that totally distorts the lending ecosystem, specifically the corporate bond market. I mean, if you were an investor, why would you buy a corporate bond to help a local business build a factory, taking on inherent risk, if the government guarantees you a high risk-free return in a savings scheme?
Right, you just wouldn't.
Exactly. Because of this crowding out effect, India's corporate bond market sits at a meager 18% of GDP, while the equity market has soared to 130%.
It creates a completely lopsided financial system where businesses struggle to find affordable debt. The reform suggests gently tapering those guaranteed small savings rates so that capital naturally flows back into market-priced corporate bonds.
Deepening the debt market so businesses can actually afford to borrow and grow. Now, if we connect this to the bigger picture, we've patched the physical leaks in logistics, and we've unlocked the necessary capital. But if you recall the rocket analogy from the beginning,
The third stage.
the payload that has to carry the economy to $20 trillion is services. And to run a massive high-end services engine, you need highly skilled humans. This brings us to the human capital funnel, and the bottleneck described in the report is severe.
The education statistics are intense. You have 187,000 students fighting for just 18,000 seats at the elite IITs. You have 2.4 million medical candidates chasing 118,000 seats.
It's just incredibly hyper-competitive.
When you pause to think about the human toll behind those numbers, the years of intense preparation, the pressure on teenagers, the sheer mathematical improbability of getting in, it's staggering. And because the domestic capacity is so constrained, the report notes that 875,000 students go abroad every year,
Draining $3.7 billion in fees out of the country.
Yes.
It is an export of both youth and capital. To fix this, the report leans on a historical parallel. They compare today's severe bottleneck in higher education to India's telecom sector before the year 2001.
Oh, I found this analogy incredibly helpful. Before 2001, when the government strictly controlled telecom, there were just 2 telephone subscribers for every 100 people. Having a phone was a luxury that took months or years to get approved for. But once they allowed private entry and unshackled the sector, it exploded to 85 subscribers per 100 people. The report argues that the exact same deregulation needs to happen for private universities. Let private capital build world-class educational capacity to meet the massive demand.
It is a proven playbook for rapid scaling. But this raises an important question. What about the vast majority of the workforce?
Right, the non-engineers.
Exactly. Even with private university expansion, not everyone is going to be an engineer or a doctor. How do you skill the millions of youth entering the broader workforce every single year?
The report leans heavily into apprenticeships for that. Currently, only 0.1% of India's workforce are apprentices. Contrast that with 1.7% in the UK or 4% in Germany.
That's a huge gap.
The current system relies almost entirely on giant corporations to provide training. The reform proposes offering tax deductions to incentivize those smaller MSMEs we talked about earlier to take on apprentices.
Yeah, the goal is to turn a demographic youth bulge into a certified skilled workforce rather than just a generation holding, theoretical paper degrees with no practical experience. Taking that a step further, the report specifically calls out the tourism sector.
Okay, how so?
By formally recognizing hospitality and local guiding as certified trades with structured apprenticeships, you professionalize an entire industry. The report points out that just closing the tourism receipts gap to match a country like Turkey would add about
And if you want those skilled workers to transition into the high-value jobs that define a $20 trillion economy, you also have to fund innovation at the university level. Currently, India spends just 0.8% of its GDP on research and development, and most of that is publicly funded.
Right.
South Korea, for comparison, spends 4%.
The output gap resulting from that lack of funding is stark. India filed roughly 65,000 patents recently, whereas China filed over 1 million.
That's a massive difference.
Yeah, and the report identifies that the fundamental flaw is the funding model itself. Indian universities are largely funded based on headcount, essentially how many students they enroll. The reform argues that government funding must be strictly tied to outcomes. the number of citations, the patents filed, and the industry partnerships formed.
So you have to financially incentivize the actual creation of new knowledge, not just the housing of students.
Exactly.
Okay, let's bring the threads together. We have mapped out a more efficient real economy. We have unlocked the capital markets. We have strategies to build a highly skilled workforce. The final step of the report's agenda is projecting this economic power internationally, taking this newly built services engine global.
And a central pillar of that global projection is reviving Indian depository receipts, or IDRs. This is a financial framework that has been largely dormant since around 2010.
Before we get to the projections, can we just pause on what an IDR actually is mechanically? Because it sounds like heavy financial jargon.
Sure. Simply put, it is a wrapped asset. Imagine a bank buys shares of a major company in Brazil, holds those physical shares in a vault somewhere, and then issues receipts representing those shares on the stock exchange in Mumbai.
Okay, I'm following.
Indian investors can then buy and trade those receipts in rupees. It allows local capital to invest in foreign companies without dealing with foreign exchange complexities or offshore brokers.
So it makes India the financial hub and clearinghouse for the global south. The report estimates that if they clear up the regulatory rulebook and resolve tax ambiguities, they could bring in 50 global companies listing at $2 billion each. That is $100 billion in new listings sitting on Indian exchanges.
But to get those foreign companies and international investors to actually participate, you have to address the transaction taxes. India currently stacks two separate taxes, the securities transaction tax and stamp duty, on the exact same cash equity trade.
Oh, so it's double taxation on every trade.
Yep. Removing that double dip is framed as crucial to shifting India from a somewhat closed-loop, highly taxed financial system into an irresistible magnet for global capital.
Got it.
And attracting that global capital is how you directly fuel the 18% dollar-denominated growth rate we discussed at the very beginning of our conversation.
But projecting power isn't just about financial markets, right? It's about how the country physically sells itself on the world stage. The report suggests a total paradigm shift in diplomacy. Currently, when the Prime Minister visits a foreign country, it is mostly a government-to-government dialogue. The reform suggests turning these state visits into aggressive, calculated trade and tourism missions. Bring the top 10 importers and exporters along on the plane, make it a literal sales pitch for the country.
It's a brilliant blending of traditional diplomacy with hard-nosed capitalism. It signals a necessary shift from a bureaucratic mindset to a commercial one. And this diplomatic push supports the continued scale-up of Global Capability Centers, or GCCs.
Right.
India already hosts over 1,800 of these centers, which accounts for half the world's total. These are not just call centers. They are the global nerve centers for multinational corporations, handling R&D, IT, and high-level analytics.
And the strategic goal is to scale that footprint to 5,000 centers by 2030, deliberately spreading them beyond the massive congested metros into Tier 2 and Tier 3 cities to distribute the wealth. So, what does this all mean? Why have we spent this time dissecting one research document? Because whether you are an international investor looking for yield, a local entrepreneur trying to understand market shifts, or really just anyone interested in global geopolitics, India's roadmap is the ultimate real-time case study.
It really is.
They are attempting to engineer unprecedented economic growth. And crucially, they are trying to do it by vaulting over the traditional manufacturing phase and relying directly on a high-tech services engine to jump from a $3.6 trillion to a $20 trillion economy in just over a decade.
And that leads to a concluding thought I think we should leave you with today. Historically, every single major economic superpower, whether it was the United States in the 20th century or China in the 21st, built their foundational wealth by becoming the factory of the world. They relied entirely on that second stage of the economic rocket to lift millions out of poverty. But if India actually achieves this $20 trillion leap, well, if they manage to successfully skip the factory floor and establish themselves as the office of the world, what does that mean for the future of work globally?
It completely rewrites the accepted rules of economic development.
It does. Will other developing nations in Africa or South America look at this and be forced to abandon the manufacturing playbook altogether? It represents profound structural shift in how nations might develop and compete in the coming decades.
It really makes you look at that 5.5x growth goal from the beginning of our deep dive in a whole new light. Thank you so much for joining us as we unpack this roadmap. Keep questioning the consensus, keep exploring the data, and we will see you next time.